All right, here we're taking a look at Departmental Accounting Part 3. And this is where we've already gone through up to gross profit, and then we went through and did allocated indirect expenses and calculated out the total operating expenses and then the operating income for each department. Now, here we're going to take a look at a slightly different way of looking at the operating expenses. And here is where we want to take a look at just the direct operating expenses. And we have a special vocabulary here. If we take the gross profit and subtract out the departmental direct expenses, we get departmental direct operating margin. Then from that, if we just subtract the total of the indirect expenses without bothering to allocate them, we would still come up with the operating income. Now, sometimes we do this type of thing because we're looking at trying to do like a performance evaluation on that manager. And each department manager, they don't have control over how much we spend for the store rent. So why even involve putting that in their evaluation? But they do have, they should have some kind of control over the sales, the cost of goods sold, and the direct operating expenses. So if we just work with those and take a look at the direct operating margin for each department, we can get down to that's how much each departmental manager had control of. Okay, so here we are back at Annie's, and now what we've done here, we still have the sales minus the cost of goods sold is the gross profit. This top part is still the same. But now notice that instead of just the total operating expenses, we have just the direct operating expenses is put in here. And so the store clerk's wages, remember for golf was $36,000. That's the two clerks that only work in golf. And the one clerk, $15,250, that only works in tennis. So we have a total of just direct store clerk wages of $51,250. Again, the truck drivers only had one truck driver that was a direct expense. The advertising, we had $17,000 of advertising expense in the papers. For golf, $12,000 for tennis. The rest was allocated. Bad debt was all direct expense. Depreciation, we had one truck to put the depreciation on. And for just all the other lumped up operating expenses, we had $84,420 of direct expense for golf, $31,980 direct expense for tennis. So now I can add up all these direct expenses, and I get $184,420 for golf, $68,130 for tennis, $252,550 for the grand total of direct operating expenses. Now I'm going to take the gross profit for each department minus the direct operating expenses for each department. So here's gross profit, $529,720 for golf, minus the direct operating expenses, $184,420 for golf, and that equals $345,300 of direct operating margin for that department, for the golf department. For tennis, I have gross profit, $219,400, minus the total direct operating expenses of $68,130. That gives me direct operating margin for the tennis department of $151,270. Then I would just put the indirect operating expenses just as a grand total, and I'm not overly concerned with them. I'm looking at just the direct operating margin. This is the amount that these two managers had absolute control over. So to get percentages, if I take the 345,300 of the direct operating margin for Gulf divided by the Gulf sales, I get 32.1%. That's my direct operating margin percentage for Gulf. For tennis, I take the tennis direct operating margin divided by the tennis sales, and I get 23.6% direct operating margin percentage for tennis. Again, Gulf is better, a higher percentage. Okay? And we would have to investigate, is that because of the gross profit was higher, because the operating expenses, the direct operating expenses, or both had a say into what these percentages turned out to be. Okay, I can also take a look at the direct operating expenses percentage. So I take just the total operating expense divided by sales. So Gulf had 17.2% of their sales ended up being in direct operating expenses. With tennis, I took their total direct operating expenses divided by their total sales, and I get 10.6%. This time tennis is better. In other words, we don't want a bigger number, we want a smaller number. This is the percentage of expenses. And so tennis had a lower percentage of direct operating expenses. And so the tennis departmental manager did a better job of keeping their departmental expenses down. Okay. Direct operating margin also helps us to determine the contribution a department makes to the overall operating income of the company. Now, this is before we've subtracted any indirect expenses, but this tells me that Gulf has $345,300 worth that it can apply toward indirect expenses, and tennis has $151,270 that it can apply toward taking care of indirect expenses. Okay, so we're going to go on to a different topic, and this is discontinuing a department. And sometimes we have multiple departments, and one department is just not pulling its weight or even has operating losses in it. And so management needs to determine on paper if we really need to discontinue this department. If you take away that department, all the sales goes away from that department, and you're also laying people off of that department from their jobs, and maybe it comes out in the end that you shouldn't have done that because now the store as a whole is actually worse off than when you had that department in there. So sometimes it's better to see what can we do to change the department, not just get rid of it. Okay? And what we look at when we're doing that is this direct operating margin that we just got done talking about. Okay? If that's a positive number, then you should not just discontinue that department. Okay? You can make changes, but you shouldn't just get rid of it and have nothing in place because you're going to be worse off. Okay? When we take a look at the indirect expenses, they're for the whole business. They will not be reduced when the department is discontinued. So if we had to pay $10,000 for rent expense for the whole building, just because I get rid of Department D doesn't mean my rent's going down. I still have to pay that $10,000. Okay, so I'm going to get rid of the sales for Department B. I'll also get rid of any direct operating expenses for Department B, but I can't get rid of the total indirect expenses for the whole store. Now just 2 departments are left over to take care of those indirect expenses. Okay, so here is an example. So here we have Department A, Department B, Department C, and here's the grand total for the whole store. And if we look down at the bottom, our operating income for Department A is $13,000. Our operating income for Department B is $8,000. And we have for Department C a loss. It's in parentheses. That means it's negative. We have an operating loss of $5,000. So management wants to take a look and see, should we get rid of Department C and just have A and B? So what we're going to do is we're going to make a new total column, and that total column is just going to be just A and B. So we're going to try to get rid of Department C on paper and see what it does before we start doing anything rash. Okay, so now I'm just going to add up A and B. So here's the sales for A is 210 and for B is 185. Together that equals 395. And here's the cost of goods sold for A and B. That's 225. The gross margin or gross profit for A and B is 95 and 75. That's 170. Or, of course, you could have taken the 395 minus 225 and got 170. The direct operating expenses for A and B is $100,000. And then when I subtract that from the gross profit, I get the direct operating margin, 40 and 30, confirms it, that's 70. Now I get down to the indirect operating. I can't just add A and B. I have to add C in here as well, because that part of that stuff like rent expense and stuff that just because I chop out Department C doesn't mean that 25,000 goes away. Like all the rest of this stuff does go away if I get rid of Department C, but not indirect expenses. So the grand total of indirect expenses for the whole store is still $74,000. That hasn't changed. But now I only have $70,000 of direct operating margin for the store as a whole, minus $74,000. Now my now I have a loss, an operating loss for the store as a whole. Before, I had net, operating income for the store as a whole. So I had $16,000 operating income for the store as a whole. And now, if I get rid of Department C, I have a $4,000 loss for a store as a whole. Because now the $74,000 of indirect expenses, I got to allocate that only between A and B. I can't spread some of it out in Department C, and Department C sales takes care of some of that. So in this tells us we will be way worse off if we get rid of Department C. So Department C, if you look at the direct operating margin, it has a positive number. It's 20,000. Department C's 20,000 is helping take care of some of that indirect expenses. So we should not get rid of Department C. We need to keep Department C.